It has been obviously that Treasury yields have not backed down. We've not had that familiar response of yields going down. Is that because the big fear in the background is no longer deflation, so that we are kind of in a different set of muscles being used here in the bond market? And does it mean we're in a higher range for rates, if nothing else?
Yeah, so if nothing else, I think we're in a higher range for rates. I think that the low rate, low volatility environment is probably over. We know that QE is coming to an end, not just in the U.S., but also in places like Europe. So the forces that were pushing rates down and keeping volatility low have probably all but subsided. It probably subsided at this point. So what that means is that you have to give more expectation for interest rates to rise. So when we have good economic data and good growth and good jobs and good wage numbers, you should expect interest rates to rise. Now, there is an offset to other financial assets. What the markets are going through right now is they're actually trying to make that adjustment in risk premia. So term premia or the discounting for inflation risks is coming through the market right now. It's putting pressure on other markets. However, if you look at high yield, if you look at emerging markets, if you look at investment grade, all of these markets are handling it very, very well. Performance is still reasonably decent, on the year. Yes, there's been some give back, but markets of liquidity, there's no real funding shortages. Liquidity is good. And the number one thing to watch right now, if you want to know if this is going to become something bigger and more systematic, is the dollar. The dollar has become a funding currency that people have used to borrow money in to buy other risky assets. If there is a wholesale liquidation in just financial assets, it's going to go get repatriated back to dollars. We're not really seeing a significant amount of dollar strength. That should be a signal of calm for the markets and understanding that this is more probably of a technical, idiosyncratic thing that's going through the equities right now. We're not seeing this as a global systematic factor.
Yeah, and to your point about both the age of low volatility being gone and maybe it's an equity-specific thing, we did see the stock market rollover. We're showing you there the Dow down 182. It actually briefly was down more than 200 after being up more than 200. So this idea of these kind of weak rallies getting knocked down at least all week have continued. Krista, if we are in a slightly higher range for rates, what does it mean for stock market valuation on the longer term?
So I think we have to kind of maintain the context here a little bit. Rates have risen. They may rise some more. But relative to what earnings yield is, the profitability of companies, rates are still relatively low in our view. So I think the rates even at these levels continue to provide is valuation support to the market. And I think that will be the case for quite some time still. I think Jim is absolutely right. This is not the end of the world. This is basically us getting used to the idea that rates markets and other markets will provide volatility and equity markets would react to it. We are still up relatively big amounts since beginning of last year. If you look at credit markets, things are very, very stable. This is not a systematic issue. This is a correction. People say healthy correction. I guess no correction is really healthy correction. But it's a correction, and we just have to adjust to it.
Jim, I think you believe that the new sort of band, so to speak, for 10-year yields is somewhere between 2.5% and 3.25%. Why?
Well, I think if you look at growth and if you look at where inflation dynamics are headed, inflation's probably headed to around 2%, this year. The question mark then becomes, do we get better growth expectations into 2019? And I think the answer is probably yes. So can we get to 3%? Can we get a little above 3%? Yes. Can we sustainably stay there? We need to see more economic data, good economic data continuing down the pike in order for us to sustain those levels. I think levels above 3% in the 10-year note are going to be really hard to maintain unless we start to see better